All right, so the Fed minutes just came out for the December Fed meeting, and the immediate reaction in the market here over the course of the last 30 minutes, the market's just tanking. The S&P is down about a full percentage point right now, and the Russell and the NASDAQ are each down about 2%. It's interesting though, because I didn't really think that the Fed announced or said anything that was particularly new. We all know that the Fed is getting more hawkish. We know that they are increasing the rate of tapering of the bond buying program, and that they have fast forwarded the expectations of when interest rate hikes should come into the market. That has led to some interesting movements in the market the last couple of months. Particularly, we've seen destruction in growth stocks, and especially so far in the beginning of the year. I know there's only been a few trading sessions so far here in 2022, but we've actually seen really positive moves in value names, energy names, and the banks. But again, I didn't really see anything that was particularly new that came out of the Fed minutes that's causing this immediate destruction in the market. Though I've also had the feeling over the course of the last couple trading sessions that the market's been just looking for excuses to sell. So this just could be another one of those excuses. There were a couple key comments that came out of the Fed minutes that I do want to highlight and I want to review with everybody. First, from the FOMC meeting minutes, several participants raised the idea that structural factors that kept inflation low in the previous decade might reappear once the impacts of the pandemic wear off. So that's an interesting comment. It's actually one of the more bullish comments that's come out of the Fed minutes. Basically, the structural factors that kept inflation low. That's what they're talking about here. And that those structural factors which kept inflation low might reappear soon once the effect of the pandemics wear off. The number one thing here is, I guess, to take a half step back. If you go back to the financial crisis, 2008, that's the last time that we did a significant amount of stimulus in the economy, like very significant, right? With that said, what we did with the COVID pandemic makes what we did in 2008 almost look like a drop in the bucket. But back out of 2008, when the Fed really pumped a lot of money into the economy to try to, save us, a lot of people were coming out and expecting inflation. And while we maybe saw a little bit of inflation in 2013, it really never came to place. Why? Well, that has to do with the structural factors that they're referencing here in this comment. Those structural factors are first and foremost innovation, globalization, innovation, like what Amazon does. The fact that a company like Amazon exists, and you could make arguments that are both for and against the existence of Amazon. For example, Amazon has definitely made it more difficult for your average mom and pop store to exist. You could definitely make an argument that is bad, but Amazon has made it really easy to get pretty much anything that you want at a really low price. And that's from their innovations that they've put together. So those low prices that come from technological revolutions actually help to damper inflation. They keep the prices they basically hold prices down, right? So that dampers inflation. And basically this comment here is, well, once we get through the pandemic, we kind of expect the pace of innovation to go back to what it's been, and that will continue to hold inflation down. So that's actually a bullish comment, right? Because the effect of increased inflation is the biggest thing that is causing or potentially forcing the hand of the Fed to raise interest rates. So that's a comment that says, hey, maybe we're not using the word transitory anymore, but once we can get through these supply chain problems, once we can get innovation to come back online, globalization to come back online, that will naturally tamper down inflation, and maybe we don't need to raise rates as much as possible. So that was an interesting comment. Here's another one though, and this comment that came out of the Fed is definitely bearish, and I want to analyze this one as well. Several participants discussed the danger that recent high levels of inflation will raise the public's longer-term inflation expectations to levels higher than those consistent with the committee's longer run inflation aim. This is a really dangerous comment that comes out of the Fed. Let me decipher for you exactly what this means. We have to go back in history a little bit to really understand what this comment means. Let's go back to the last time that the United States saw major, consistent inflation coming in. We got to go back to the 1970s. For a whole host of reasons, inflation began to increase in the 1970s, and there was a couple major years of double-digit inflation. In 1974, we had inflation that was about 12%, and then in 1980, we had inflation that was at about 14.5%. And inflation stayed really consistent there throughout the mid and late 70s until eventually in 1981, Fed Chairman Paul Volcker dramatically increased interest rates, dramatically increased the Fed funds rate in order to basically create a economic recession that had the impact of finally bringing down inflation. But the question is, why was inflation so persistent in the 1970s, and why did it take a manufactured recession from the Fed to actually taper that down? It's all about this key phrase in this comment here, that the public's longer term inflation expectations, that they're worried that these high levels of inflation will raise the public's longer term inflation expectations. So what you had happen in the 1970s, when inflation got really out of hand, that created almost like a feedback loop that led to further inflation, was once inflation persisted for a period of time, the companies that actually manufacture goods, they started to build into their models of their expectations of their input costs these large amounts of inflation. Once they started to build that into their models, and then therefore build that into the price that they're charging consumers, that's what created this feedback cycle of inflation. So if Procter & Gamble, which definitely existed in the 1970s, or US Steel, just to use some examples, General Electric, if they started to think in 1974 when it was 12.5% inflation, well, we think that this is probably going to stay this way in 1975 and 1976, they have to model out their expected costs and what they expect to be able to sell their goods for. So they started to price that in. And then once the market begins to expect that, that leads to a continuation of inflation. So that's what the Fed is really worried about. They're really worried that if this level of inflation persists, that our modern day companies, our modern day US Steel, our modern day General Electric, our modern day Boeing, that they're going to also have to start creating models that input these higher levels of inflation, and that inherently causes inflation to stick around for much longer. That's exactly what happened in the 70s into 1980 until Fed Chairman Paul Volcker did something extremely brave that I don't even know if you'd be able to do in this modern age without tremendous amounts of backlash, where he raised the federal funds rate, I think, to 20% to manufacture a recession in order to actually finally drive down those inflation expectations. That's what we had to do. The Fed is saying that they're worried of that exact same thing happening again right now. It's potentially super bearish. So they might have to start really increasing interest rates. I actually want to employ some real second level thinking on this. The Fed right now, they are more open to providing information than they ever have been in the past. They know that sometimes just the threat of something can have an effect. The fact that they are studying history, that they know what happened in the 70s and 80s, and that they are already talking about having to do this, and that's actually what's tanking the market right now as we're having this conversation, that might be enough in and of itself to start to taper down inflation a little bit and begin to increase interest rates before the Fed itself even does it. What this is leading to right now, 30 minutes or so after these Fed minutes, is that the futures market is implying a more than 70% chance of the Fed raising rates at their March meeting. That's definitely sooner than I expected. We'll see if this actually comes to play or not, but right now, that's what's going on. That's the big worry about the market. That's why inflation is so important, and this is the importance of the Federal Reserve on the marketplace. So it's a little bit scary, but I'm inclined to think that the Fed getting ahead of this and talking about it so early is going to be enough in and of itself, maybe hold inflation back and maybe we're not going to have to raise interest rates as fast as the market is currently expecting, but we'll see. You should definitely check out the Pro Desk virtual trading floor that I'm running. There's some links in the description there where you can learn about how you can get involved. And there's also a link to my free ebook where you can learn about becoming a professional trader at T3 Trading Group like I am. See you next time.